guys? It's Joseph with What Joe Knows, and thank you for tuning in to my channel today where we focus on personal finance, real estate, and life. So today I wanted to bring up a topic. It may be something that you're aware of, but it's a recent development in 2020 that you may or may not be aware of, but has a great impact on all of our lives, okay? I mean, this directly impacts your pocketbook, your coins. So stay tuned and listen up, guys. So the development is the new 2020 FICO credit score changes. I mean, FICO 10 is switching up their metrics. They're switching up their entire system. And it's estimated that 80 million people will be impacted. Either the scores are going to go up or they're going to go down, but they will be impacted. You need to be aware of these changes because they can impact whether you get a loan to buy a house, a loan to buy a car, a credit card, or personal loan. I mean, your FICO credit score is one of the most important numbers in your financial life, okay? It is so important. Everything you need to build a life of abundance starts with credit. Like, credit is king. This is why my number one piece of advice to those of you out there who are trying to get your life, your finances together, would be to just focus on fixing your credit as quickly as possible.
Just do it. Fix your credit.
So, I mean, let's think about it for a second. Your credit score is used in about 90% of lending decisions. It's going to determine everything, guys. It's going to determine whether you get that loan or line of credit in the first place. And let's say that you do get approved, it's going to determine what type of interest rate you're eligible for. So the higher your credit score, the lower interest rates you're eligible for. So that means you're going to save money. You're going to pay less in interest over the long term when borrowing money. So FICO has now switched to what they call the trended data model, which basically means that they're looking more closely at your spending patterns over a period of time. So gone are the days where you could just quickly pay something down or pay something off before applying for a mortgage or car loan. These people did that all the time. And then right away they would get approved, like right after. So with the new changes, FICO will be looking at certain spending financial patterns over several months versus just looking at the last month. For example, if you fall behind on your bills for 3 or 4 months, well, guess what? Get ready to pay more in interest because you're going to be penalized. If your debts are creeping up like month after month and it's becoming a pattern and you're falling behind on your bills, trended data is going to notice these changes and your credit score will drop significantly. So my recommendation, the best way to avoid your credit taking a drop under this new system would be 1, pay your bills on time and avoid any excessive spending charges if possible. So in the past, people would get a debt consolidation loan and pay off their credit cards. So they would just get a loan, pay off their credit cards, and their credit scores would just like jump through the roof, just humongous, because they're showing a low balance or zero balance because the revolving credit lines are low. However, now, if you get that debt consolidation loan and let's say you run your credit cards up right away again, you're going to be judged more severely under the new guideline. And the reason for the changes, according to FICO, is that despite the strong job market in the United States right now, there's a significant number of lower and middle income Americans who are struggling. It's hard out here. And consumer debts are quite high right now. So the banks, the lenders, they're always trying to find ways to protect themselves from losses. And you know, the economy may change. If it changes for the worse, they're just trying to insulate themselves. So FICO says that they feel these new changes are going to make it easier for lenders to gauge a borrower's risk. So instead of looking at a static month of your balances, FICO 10 will be looking at 2 years or more, guys. That's a big change. So it's going to give lenders more insight into how you really manage your credit, how you manage your finances over time. This means that your credit scores are going to better reflect like the overall trend of your spending behavior. So again, the best thing is just monitor your spending habits, make sure you pay your bills on time, and whenever possible, keep your credit utilization below 30%. Now, credit utilization represents the amount you owe or are using compared to your available credit limit. So for example, if you have a credit card with a $1,000 credit limit, you'd ideally want to keep your balance below $300, which means it's a 30% utilization. What you need to understand is how you manage your credit is a third of your score. So if you're maxing out your credit cards with high utilization, even if you are making those minimum payments, your score takes a dramatic hit. It goes down significantly. In some instances, it may make more sense to spread out your balances over multiple cards. than having one card maxed out. So the biggest change in the guideline revolves around the amount of debt you carry. So in the past, like I said, people tried to polish up their scores right before applying for a loan. They were told to pay down their credit cards, get their balances as low as possible, like a month or two before submitting an application. Well, that shit doesn't work anymore. So you really need to plan ahead. You need to know what you're going to be doing, and you have to now think in advance. So if you know you have something big coming up that you're going to want to apply for, try to get those balances trending down or paid down several months in advance. So think long term before applying. So the good news is, despite the changes, the 5 broad factors that drive your credit score have not changed, and I'm going to list them in general order of importance. So first is your payment history. Second is the percentage of your credit used. Third is the length of your credit history. And fourth is the mix of your loans and how many new accounts you've applied for. That means that all the traditional advice still holds and still applies. So you may be wondering, well, what can you do? But to sum it up in a brief explanation, because the new FICO 10 calculation looks at a longer history of your credit, it just pays to get your financial life in shape as early as possible. Before applying for any loans, anything like that, the sooner the better, just plan ahead. So I know I covered a lot of information in a short period of time. I really hope you found value in today's content. If you did, please give it a like and a thumbs up. And as always, feel free to leave any comments or feedback, because it really does help to support and grow the channel. And remember, I, Joe, also want to know what you know. Thank you and have a great day.